I'm Tim Quast. This is the Edge demo for July 6th. Hard to believe, 2023. Only two rules of the road here. During the comments, if you would, just mute yourself because I sometimes will give feedback and you just never know what will happen in the background. That's very helpful. And then ask lots of questions. So that is really it. And if I mute you, please take no offense. I may mute myself. Okay, there we go. All right, so we've got a bunch to cover, and for the sake of anybody who's new, and I get these notes and I get these reminders to look, don't just skip past the neophytes to Edge and talk only to the veterans, and it's a good reminder. I won't take a lot of time doing it. My aim is 2 or 3 minutes. I just want to hit a couple of high points about the platform. Then we can get into these things that I think are important for us to cover, so that you can keep taking gains, not chances. I hope you are. I wasn't sure how the day would go today, but it's turned out fine. I have made money even in this market by using the math. That's all you got to do. It doesn't work perfectly, but it works pretty well. Okay, so I'm going to share my desktop here. Go to the app. And I want to hit this is for the benefit. Yeah, so you veterans, if you want to check out for about 2 or 3 minutes, you can. And if you're new, I want to show you very quickly a few things about Edge. So how do you use this platform and what is it predicated on? Well, if you go up here and you hit how it works, this should, in theory, take us over to the landing page, and it will say learn how to trade supply and demand instead of price. And there are a number of videos here that will help you. Those are fairly general, but they hit many of the high points. If you go to resources and you hit how to use Edge, there are the intro videos. And I'm not trying to push you off to these videos, but I think they're short, quick, snappy snippets that will help you understand how to use the platform. Now, back to the platform, it's predicated on a very simple premise that the way price will behave lies at the nexus of supply and demand. It's sort of economics 101. And everything we do here on this platform is predicated on finding the supply-demand balance in things. So for instance, this is an introduction. If you go up here to the quick search, hit Apple, this is what I mean. The green part of the graph is demand. It's an algorithm that is measuring buying and selling in context of market rules. What makes Edge unique is it's wholly predicated on the rules that govern how trades execute. It's very complicated on one hand. On the other, it's also very uniform. When there's complexity and a bunch of rules you have to follow, well, it makes it mathematically measurable. So that green thing that you see, that is demand. This is Apple's closing price. And down at the bottom is a measure of supply. It's short volume, not short interest, short volume, the percentage of trading volume in Apple coming from borrowed stock. It can be borrowed by people who short the stock. It can be borrowed by market makers who are simply trying to fill orders. But you'll notice that over this 30 trading day period, demand in Apple is pretty level and supply has declined. Well, what will price do? It will rise. And you don't have to know anything else about Apple than that. And when demand rises and supply falls, then price tends to rise more rapidly. When supply rises and demand does not, price slows down. When demand stays level and supply dips, price rises. When demand and supply both rise, the one that rises faster will probably dictate the outcome. I mean, you can't say absolutely, but look at this big increase in supply, and so Apple's price slows down. That is the whole basis of Edge, really. There are a couple of other simple things to know, like creating portfolios. You can do your own. You could go over here and put your tickers in, just put in whatever you want. We'll just do a handful here to make the point. What else? NVIDIA, some popular stocks. You can call it My Stocks. And you can come down, hit tab. If you wanted to describe what's in there, put a little description, you hit create. Now you got a portfolio. It's not more complicated than that. If you want to use market structure to create a portfolio for you, let's suppose that we wanted to find demand that is equal to 10, as high as you can get, very strong demand that has slammed into the ceiling, and we want to find a market structure sentiment trend that is up. That can only be true on one day. It can only be at a 10 and up on one day, the day it arrives there. But let's suppose that we wanted to do that and that we call this tens. Now you got a momentum portfolio. And we go over here and hit create. Now you have a portfolio that will find that stuff for you every day. And this portfolio has 100 stocks in it, I believe. Let's go down to the bottom. But that doesn't mean you can trade them. A stock that doesn't have any liquidity, like ARIS here, $627 a trade, you can't get in and out of it. Those are very risky. We have ways to address that, but it's very simple. I'm going to just get rid of that portfolio. But it's not, really easy to use math to help you find things in the market that are reflective of supply demand opportunities. And so we create 14 portfolios, momentum and low volatility. That's what I trade. That's it. I don't go look at the rest of these other than informationally. There are 14 total that we put on your desktop automatically, or your dashboard. Big tech here. Why is the market suffering? Because big tech dropped to a demand deficiency. It's starting to recover from that, but it's predictive. It's a leading indicator. If demand falls in big tech, which is a major part of the market, there are these 8 stocks that are, call it, 30% of the major indices, and tech by itself is 28% of the market. Probably the market's going to have a hard time rising. And you're going to know that in advance. And then there are the 11 sectors that we create for you in addition. Okay, those are some basics. Those are the things to know. What makes it unique is supply and demand. These green and gray graphs, they're just showing you in that portfolio what the supply-demand balance is. If you're trading low volatility, you want to have falling supply and steady demand. I traded several today. I got stopped out of one, I got stopped out of 2 positions, and yet it still worked out fine. I'm up for the day. Momentum is rising demand, falling supply. Tends to create more movement, but that's it. All right. So now, there were some of you who were invited through this. Is the market at an inflection point? So I want to address that right off the bat, and then get into some real nuts and bolts about simple trading. How do you trade momentum in any market? Again, this is not, there's no perfect approach, no perfect system. I'm not trying to tell you that there is. There are rules that govern outcomes, and we can use those to our advantage. We just tip the odds in our favor to the best of our ability. So is the market at an inflection point, and how might you know? If I look at, broad sentiment at the top of your dashboard is the risk management tool. And it's going to meter the same thing, buying and selling in the S&P 500 stocks. That's what this green thing is doing. The price metric here is SPY. This is for those of you who are new. And here is supply, short volume in the S&P 500. Notice that much like Apple, demand's been pretty good and supply has been declining. Well, what does that tend to do to the market? It will lift it. Where we might begin to see a change in behavior, there are 2 things here that stand out to me. During this period, where right into May options expirations, where the market was basically flat, trading in this range, supply was pretty high, over trend. The trend was down, but these 2 humps that you see, that is excess supply, and demand just hanging around 5. Well, it's very difficult for the market to rise. Then look what happened as we headed into options expirations in June. All kinds of things happened in June. Index rebalances, quarterlies, Russell rebalances, the options expirations, and we saw an explosion. If you remember that in following May expirations, all of a sudden, boom, we had all kinds of momentum trades in the momentum portfolio. And we saw supply drop off the cliff and demand increase, and the market shot up. Now we could be seeing a change develop. Because if you were looking at this mathematically, you could say, well, this is the reverse of this. These 2 excess supplies have been replaced by insufficient supply 2 times, but the bottom this time is higher than it was this time. If this continues up, the market is at an inflection point. I don't know if it is. One day isn't a trend. It's not surprising to me that the market would have a down day, because demand, the supply is rising faster than demand. Demand bottomed, but supply began to jump. So now we have a convergence. Divergences lift prices, convergences drop them. Yeah, I don't know. I don't know how much it's going to drop, but certainly those conditions are measurable. There's also this weird thing that occurred right at index futures expirations for the month of June and the end of the quarter. That's where prices ran up. Bam, 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 right into it. And so demand was falling and supply was falling, and somehow prices rose. That's not common. And it suggests that the cause is the derivative, that little green rectangle there that tells us on the calendar that index futures expired there. They expire each end of month. And so sometimes that causes a mean reversion. If demand for implied securities or implied stocks, which is futures or options, is very significant because people don't want to miss out, or they got to true up their tracking, or whatever the motivation is, you can get an imbalance between the derivatives and the underlying asset class, and it will have to reset. Now, I'm not saying that's what's occurring today, but you can look at all that data and say, is the market at an inflection point? Well, we certainly thought that June would be a high point, that because we had this great period and things are going to rebalance. Is that sustainable? Well, we'll see. But if there's going to be a turning point, that's where it comes. And you will always know looking at this, not perfect, but people don't talk about it enough, that the market has all these very measurable periods in time, a cadence and calendar, and a supply demand balance that you can observe. And it gives you a pretty good idea to know if there's going to be an inflection point. If we expand this back 3 years, just to have a long-term perspective, and I'll finish with this particular point, it's very interesting to see what causes the market to do well and what leads to a turning point. When supply and demand are pretty well balanced, the supply side has risen the whole time. But if we're right at trend, and demand staying very close to 5.5 and spending a lot of time between the red and green lines, getting some momentum in there, market tends to do pretty well. When it begins to break down, the market tends to stall. If supply jumps above trend, that tends not to be good. If you have a big increase in supply and weakening demand, what will happen to the market? Well, it comes down. So if you look at where we are currently in that 3-year view, you would say it doesn't look bad. Demand's not bad. It's sitting there pretty close to 5, and supply has been at a significant deficiency. That, to me, is the thing to watch. Is this sustainable? Well, if you look back historically, no. Unless the market comes down dramatically, you don't have these sustained supply deficiencies. They don't happen very often. So if we return to trend and demand doesn't change, the market's coming down. If this jumps above the trend and demand doesn't change or demand weakens, the market could come down for a sustained period. I don't really care. We all want markets to rise because we have long-term portfolios. So do I. I would much prefer a rising market to a falling one. But will it change what we do trading supply and demand? Not really. We're going to continue to use what the math gives. Okay. Now, before I move on to the next point, I want to see if there are questions to address. Have I missed anything? And again, interrupt me anytime. If you've got an observation, Gary, TSN. Okay, let me go look at the chat here to see if I've missed. Okay, well, TSN. Okay, let's see. Here's what I do, Gary. We'll look at TSN. And Dan Eisenberg, you made this point too to me, and I used it in the market desk note today. What am I looking at versus, what period of time? I like this quick search view. It's only 30 days. It's not a long range view, but the market's continuously changing. What happens every 30 days? Well, there will be at least one options expirations period, at least one month-end index futures true up. Those things are followed by trillions of dollars. People's will have macroeconomic data inputs like the Fed meeting, July 25th, 26th. coming up. All of that stuff will happen in a 30-day view, and it will change people's minds and asset allocations and market dynamics. So I think it's good. It's not like you need years of history to understand what will happen tomorrow. This is very helpful. So here, yeah, I mean, I look at that and say, oh, that's pretty good, right? Demand's right at 5. It's a low volatility trade, and supply is in a nice downtrend. It's not a big deficit like you have here, but look, that's a stock that, given the opportunity to buy it down half or more of its volatility, you would do that. And I presume that's what you did, Gary. Which leads me to, I want to make sure I'm not jumping ahead here. Yeah, I want to talk a little bit about some data too here to buttress this. But when we talk about entry points, this is what I mean. All right, where are we getting that? I hope it's not me. Brian, I'm going to let you find that if it happens, okay? All right, so going back to, by the way, if you don't know Brian Wilson is, I mean, he's an essential part of the team on both teams. He's on the Modern IR team and the Edge team, and he's an expert on this data. Okay, so here's what I mean. And Gary, this is probably to your point. This is volatility. We define this to mean, and there, you could have all kinds of definitions for volatility. We look at the average 5-day move between high and low prices. That's what that is. And why would that matter? Because here, important lesson. If you're new to the markets, to trading, to Edge, machines set the prices, not human beings. Almost never are prices opened manually in the market. It only happens in extreme instances. Almost always the bid and offers that you will see if you go try to, you're putting in an order, a market order or a limit order, and you see the bid to buy and the offer to sell and what the gap is between those. Machines are creating those prices. How do they do it? Well, they consume historical data and they look for spreads. And how much risk will a machine take? Not much. Machines are very risk averse. Citadel does not want to lose money. They aim to own nothing at day's end and make little tenths of pennies or half pennies. So they will calculate prices. In this particular stock, if we look at Salesforce, CRM, what kind of risk are they willing to take? Well, about 80 basis points, about half that. They'll cross that spread. Well, we can use that, right? If we know there's a supply-demand imbalance in CRM and it goes down 2%, what is the probability that you could make 1%? Well, very high. Could be today, could be tomorrow, could be the next day, maybe even third day. But that is a very nice return. Let me think of an example. Let's go look at momentum. This is a good example. In momentum, the same principle applies. It's just that the risk-reward equation is higher. In low volatility, you got to settle for small gains because you can't go in and buy something and say, well, it's trading at a 14 multiple and should be trading at 15. And so there's a chance to make 5% here. Well, it's not how the market works. I wish it did. It's not how the market works. Machines set the prices, and most stocks are products in portfolios. There is an equity product, a fixed income product, real estate product, alternative investment products, and it makes a portfolio, a recipe for a portfolio. That's really how the market works. Markets work. But looking at momentum, let's take Coinbase as an example here. And I'm hitting the points I want to cover. Coinbase, here's momentum means it's much higher than 5. Right? It's on its way to 10 or already at 10. Very strong demand and falling short-term supply, but it will have higher, maybe double or more, the volatility. Well, that comes with some risk. If you buy United Airlines down 3%, could it go down another 3? Could. It's unlikely, but it could. There's a range in which things can move based on what machines will do. If they remove themselves from the equation, all bets are off. That's how markets go down 1,000 points. It happens when machines, which are setting all the prices, all of a sudden the alarm bells go off and the red lights start flashing and they withdraw from the market. Then all of a sudden no one's setting prices and boom, the market can tank. That's what happens. Human beings don't do that. It's not the way that the 100% electronic market, 98% algorithmic market like we have today works. So you have a much higher risk equation. There's volatility of 7.3% in coin. So that means you have a greater opportunity of losing money. You also have a greater opportunity to make it. So if you were looking at coin, this is how you use it. Here, by the way, is a simple way to trade momentum. You could trade anything this way. But you want the underlying principle is you have to have a supply-demand divergence. You can't just go trade volatility without knowing it. You would get caught out. And I'll have some math to share with you. If we, time permitting, I want to show you some math. So here, very strong demand, insufficient supply. It's beginning to correct, so maybe the opportunity is diminishing, but this is an opportunity. So then if we go out and say, let's go find, well, let's go to the other browser. Let's go find coin and see where it is. So let's say it opens up here at 78. Whatever the price was yesterday, that's kind of what I look at. I'm going to look at, say, 78.35. All right, so that's my measure. What is 7% below 78.35? Well, call it about 74, thereabouts. I'm just doing that rough math in my head. Maybe it's 73.50. Something like that. Okay, so that's what I'm looking at. So it opens around 78, and then it goes all the way down to, well, about there, right? So if you look at it and say, well, it's most of its volatility down, what is the mathematical probability, no matter what's occurring in the broad market, that machines, which are not, they're not concerned about fear and greed like human beings are, they're calculating spreads. What is the probability that machines will reverse that? Well, it's pretty high. So if you bought it, let's just say you bought it around 75, and you want to make 2%, what would that be? Well, it would be close to 76, 75, thereabouts. That's about 2%. Well, then there you go. You could put a 50 basis point downside on it, all the full length of coin's intraday volatility, and say I want to limit out at 76.89. And you'd get filled. There you go. And you've made your 2%, no matter what is occurring in the market. It won't work every time, but that is the basic mathematical premise. And it's predicated on understanding that machines set prices, volatility reflects the prices machines set, and they will give you some part of it. They're not going to give it all to you, but they might give you half of it. Be happy with that. That is a high probability way to make money that Citadel will tolerate. So, look, is that nice? Well, it is what it is. So we just have to work within the constraints of what we've got. Okay, I'm going to pause briefly, and I want to show you some performance data, a way to think about the market. But I want to come back to any questions, comments, observations before I do that. Let's see. Okay, so nothing else at the moment. Okay, then I'll keep going, Just feel free to interrupt me. Okay, so I've told some of you that, we've got this really, it's a rough little utility. I had one of our engineers build it so that I could go look at criteria and say, okay, what would happen if we bought stocks that are, in this particular case, that are 9 with rising demand, less than 50% short, less than 50% supply with a day-over-day decline in the supply side, and they're at least $10 stocks. And then the exit criteria are, does demand fall or does supply rise over 50%? That's what we use just to run these criteria. Then we put a risk management parameter around it saying we're going to be in the market when broad sentiment ticks up, and we'll make sure we're not in the market when broad sentiment peaks and starts to mean revert toward the nearest level near 5. And there's some additional risk. We could change that parameter. So those were the parameters we put around the market from January to June 30. So it gave us 3 trading periods where those things were true. So January 3rd to February 13th, very good time to trade stocks. We just had an initial value of 10,000 and a portfolio of 10 stocks, hit the button, took like 10 seconds to run it. and that produced a 10.5% return. Then you park it in cash and you wait for the next entry period, which was March 24th. During that period of time, there, the banking crisis occurred. That we just didn't have we didn't trigger the entry points. But from March 24 to April 28th, once again, start with 10, basket of 10 stocks, same criteria, and we ran that, and the return was 14.8%. It's a blunt instrument, might not be perfect, but it's demonstrating that consistently using math produces returns. Now you sit out, go park your cash in your Interactive Brokers account and earn 4.58% on it. And then come back May 10, up trigger again, stay till June 30, which was about right anyway. And the return on that portfolio was 7.6%. That's the weakest. But that performance is outstanding, right? I'm not saying that will work every time, nor that this portfolio would give you the stocks that will work perfectly. But there is a lesson here, folks. To me, it demonstrates, it's very easy to achieve beta, the performance of the market. Beta is the waves of the ocean, you could say. It's how everything behaves. Well, you could pay 6 basis points for IVV or SPY, even less, and get the return of the market, because 99% of stuff is the market. Very, very few stocks are outliers. And you can say, well, we'll just all own NVIDIA. Well, fine, but what happens when you get out? This is a way to use market structure so you don't get caught in those liquidity traps. And it demonstrates that math works. But you can't go do a bunch of fundamental bottom-up analysis or this thing or that thing and say, well, that's going to produce a return. It's not the way that the market works. Being an outlier is very, very, very difficult in today's market. But I thought I would share that with you. If it's good enough, it's going to take us a little while. But if we get a good enough instrument, we'll share it with you so that you can run criteria in the same fashion. Okay, brings me around to points 4 and 5. We're just about there. Let me pause again. Any observations or comments or questions?
Yes. One chat there, Tim, and Barry has
Barry
his
Bailey's
hand
got
up.
his hand up. Okay,
Yep.
Let me take this, Barry. Just let me answer Alex's question, and then the floor is yours. Going back to your Coinbase example, where would you put your stop loss? Well, I would say if you bought it and it's down, again, not perfect, because I'll show you what happened to me, but I would say that, if it's down 6.5%, well, on average, it could move 7.3%, and I don't want to lose much money. I'm not going to put it the full 7.3% down, but I might put it 50 basis points below my entry point. Right? That's kind of what I would do. And I'll give you an example. Here's my own trades. If I look at, I got stumped out of 2 things. So let's see here. Let me go to where I was. So I bought Agilent. I bought the 2 things that were in there, right? See, I mentioned them in the market desk note. I liked Agilent and I liked CRM. So I bought CRM and I got stopped out right there because I put my stop at, 209.07. I bought at 210.29. So I put it 80 basis points down. It got stopped. So I immediately bought it again. Why not? It was down, and that filled up. I limited out. I made my 1.6% on that. So that's kind of how I think about it. It's like, how much am I willing to risk, and how much is the volatility, and how near is it to the lower end of that? And it doesn't always work. It won't work every time. I got stopped out of Corteva right off the bat this morning. Because I owned that. Yeah, here's where it happened. At 7:32 this morning, my 500 shares of Corteva sold at 56.11. I had my stop in at 56.11. I bought it at 56.53, so I lost money on that trade. But I was willing to take that risk. I mean, you can see how much I traded it. I bought it, back here on June 30 at 56, call it 56.78, and I just put in a 1% gain, and I filled it, right? So most of the time that's going to work, and you just put a little downside protection in place, and that tends to work pretty well. So I had a stop at 208, and my price was, call it 210 and change, and it filled. It didn't fill at 211.73. I used an algorithm that they supply, so I gave up some ground on it, but it will sort of supply demand balance it. And I'm willing, okay, that's fine. I'm happy to take a gain on a day like today. But that's what I would do, Alex. Okay, Barry, yours.
So Steve couldn't attend today, but he wanted me to ask you to bring up Sprouts SFM and see what you thought. He said that a lot of things are lining up for it. It looked pretty good, and the analyst recommendations and price points that they're setting look pretty good, and forward-looking information looks good. So he wanted to see what you thought of it.
Okay, and Dan, you're next. I'll answer this very quickly. You know how much stock I put in analyst recommendations? 0. They are the most. If they had good intellectual property, they wouldn't be sharing their targets, would they? They would be supplying it to someone who placed value on it. They're almost always wrong, and they're almost always behind. And it doesn't. They're all looking at fundamentals, and less than 10% of all volume in the market is driven by fundamentals. So the probability that a sell-side analyst is going to be correct is less than 1 in 10. That's a little better than the Federal Reserve, but that's it. I mean, that's a little humor there. Just a little humor. Yeah, I look at that and say it's really good. The only rub is broad sentiment, right? That broad sentiment is not awesome. It's 5. And supply is rising, and it's not to 10 yet. Could it stall without getting to 10, and then does this help you? And on this side, it's still 67% short. I don't love that. I mean, I prefer to trade stuff that is less than 50% short, because at any time, if 2/3 of the trading volume is coming from artificial stock, there's a lot of air in there that's risky. But the supply-demand divergence is very good. I have not studied the math. Young Nate, the mathematician, showed me a bunch of math just before this meeting, by the way, on what happens if you bought he took the momentum portfolio back a year, the components in the momentum portfolio, and he looked at what happened mathematically if you bought those down half their intraday volatility, and he calculated in the intraday range 1, 2, 3 days out the probability that you could make 2%. And while only about 44% of stocks demonstrated that outcome, that they would decline half their intraday volatility and give you an entry point, when that happened, very high statistical likelihood that you would make money, particularly in the next 2 days. I mean, I won't say certitude, but it was a very high probability outcome. So this outcome, this divergence, has a very high probability, if the stock drops half its volatility, of producing a good return. What reduces that probability, by I don't know what factor, is the fact that there's so much short volume and it's not to 10 yet. Okay, Dan Eisenberg. Sorry.
Thanks.
You bet, Barry.
Going back to your 10 stock experiment.
Yes.
Could you go over your broad market sentiment criterion for entry and exit?
Okay. All right. So what we did, let me just go to that spreadsheet. Okay. So the risk management criteria, the uptick from any uptick from broad sentiment bottom, no matter where it was. And the exit was the downtick nearest to 5.0. So meaning that if you tick down from 5.6 to 5.2, you're out, because mathematically the next one's likely to be below 5. So that's what we used as the exit criteria. Now you would say, well, why not exit when it's over 6? And maybe so. Maybe that is because mathematically the likelihood of returns drops to 0. The trouble is you don't know the time frame. So we just wanted to make sure that our exit was before there was a drop below the demand nexus of 5. That's what we used. And we're going to run more scenarios.
Thank you.
You betcha. Okay. What else? Anything else? Let's see. Let me make sure. Okay. Chat. Am I missing anything, Brian? I've got one last thing otherwise, and we will wrap up. So last thing here is what's next? And look, who knows? All I can tell you is what the data show. Looking at what happened today. When I looked at the dashboard this morning, which is what I do, right? I'm going to go look at the broad market sentiment. I'm going to look at momentum 2. What are they? Low volatility 12. Neither of these numbers are great, but it tells you probably have better odds here. That's why I chose to buy Agilent, CRM, today as opposed to Coinbase. I mean, you can make money and you could make money either way. I just picked lower risk. That's all. But if I look at the dashboard and say, well, what is the probable next thing? Well, if tech recovers back above 5 and resumes rising, we're fine. You look at communication services, rising demand, rising supply, not great. You could look airlines, cruise ships, they look good, but it's a very small slice of the market. It's not statistically meaningful. I look at the sectors, I look at all of them. They're not great, but there's nothing terribly wrong. It might mean that tomorrow is a pretty good day. I don't know. I might try to buy a couple of things that are down before tomorrow, but it's a risk because I don't know. I don't know what's going to happen. I could look at the demand side and say it's right at 5 and it's exhibiting a minor tendency to rise, but could that be undermined by what if supply is here tomorrow or close to 50? Whoa, then I get concerned. Then I would say supply is rising much more rapidly than demand, and we're going to have trouble. That's what I'm going to look for. That's how I evaluate what's next. It's kind of I look at what the data give us each day. And so my view is if this happens, if we don't have a problem on the supply side, the market will be fine. If we do, we could be in for a fairly long slide, and we'll find out. All the people who are in the predictive business suffer reputational damage. So I don't know.
Hey, Tim, one last question out there about your short portfolio.
Okay. So I have a 75% short. I just track what stuff is at least 75% short, and there are 99 in it. And look at his financials is back in the lead. That's kind of interesting. I'm not saying it's statistically meaningful, but look at that. The average in that among that 99 now is 77%. But do I use it? I don't do anything other than it's color for me to see. And the numbers have been significantly higher at other points, but I do find it interesting that that's what the data indicates. Just informational, what are the criteria in it? All I did is this. It is literally that. It's one thing. Where is short volume greater or equal to 72%? That was my threshold, and it just gives me whatever there is in the market. All right, that's probably enough market structure for one day. I mean, that you can last this long talking about market structure is remarkable. I start talking to my wife Karen about market structure, and I'm and she's left the room. you can clear a room with this. Anyway, okay, very good. I'm going to stop the recording. Good to see everybody, and we'll do it again next week if you're game. I'll be here. Look forward to it.